Bom dia. Bom dia. Bom dia a todas, bom dia a todos. É uma imensa satisfação ter vocês aqui conosco hoje. A nossa agenda está extremamente interessante. Eu espero que ela propicie a todos vocês uma experiência única. Para aquelas com quem eu não tive o prazer de encontrar, enfim, de conhecer, meu nome é Durval Portela. Eu estou à frente da prática de consultoria tributária da PwC no Brasil. Eu sou um homem branco, cabelos pretos, ficando já grisalhos. Estou com uma barba rala bem grisalha. Estou usando um jeans escuro, um paletó azul, sapato marrom, cinto marrom e camisa branca. A Cris riu ali porque a barba está ficando grisalha muito rapidamente e o cabelo também cada vez mais. Ou seja, é melhor nem fazer a ressalva. De novo, é um grande prazer tê-los aqui. Algumas mensagens práticas administrativas para que eu passe para o conteúdo que eu mais gosto. Uma delas é que todos esses crachás que vocês estão recebendo, eles são reutilizáveis. Então, por gentileza, devolvam os crachás na saída, porque nós vamos utilizá-los para vários outros eventos. A outra mensagem é que existem headsets para fins de tradução simultânea em diversas línguas. Para o português, para o inglês, para o espanhol e vice-versa. Não deixem de pegá-los ali nos cantos, quem julgar necessário. Tendo dito isso, pessoal, um aspecto da maior relevância que eu acho que todos nós temos que celebrar, todos nós como profissionais da área tributária, é que nós estamos vivendo uma fase de extrema modificação, transformação, impacto no ambiente tributário global, no ambiente tributário doméstico. Transformações e impactos que trazem desafios para todos nós, profissionais da área tributária. E, nesse contexto, as minhas sócias, os meus sócios, buscaram construir uma agenda que Obrigado. Buscaram construir uma agenda que passa pela exploração da evolução dos principais elementos na agenda de transfer pricing global, que passa pela exploração do conceito do Pilar 2, que traz para a realidade a proposição da tributação mínima global sobre a renda de grandes multinacionais, sobre a renda corporativa de grandes multinacionais, tema que já está aí, tema que já está sendo implementado principalmente na Europa e na Ásia, que faz com que desde já tenhamos que pensar em como estar estruturados para enfrentar este outro desafio. E, pessoal, não vamos subestimar. Embora algo não necessariamente seja impactante desde já, o planejamento para o impacto começa desde já, e muita gente aqui com muito mais competência do que eu vai passar essa mensagem para vocês de uma forma muito mais qualificada. Isso tudo, pessoal, num contexto em que a gente tem experimentado, no Brasil e na América Latina, reformas tributárias impactantes. No Brasil, a gente acaba de aprovar a reforma tributária do consumo, estamos prestes a analisar, espero, num debate muito participativo por toda a sociedade, espero, sinceramente, vou ser repetitivo, da reforma tributária da renda corporativa das empresas, dos nossos negócios. Isso tudo também num contexto em que a evolução tecnológica desafia cada vez mais nós, profissionais da área tributária, sejamos gestores tributários ou consultores tributários, os nossos negócios e as nossas empresas, materializado, pontuado na inteligência artificial generativa e todo o seu potencial de trazer disrupção para a função fiscal, seja na dimensão do compliance, seja na dimensão do planejamento. Portanto, o que a gente procurou fazer, a partir de todos esses temas, e para que possamos ter a melhor experiência possível, a experiência mais interativa possível e, por que não, né, em que possamos co-criar juntos, nós desenvolvemos uma agenda em que a gente parte panoramicamente da análise de todos esses temas, segundo a perspectiva global, que será feita pelas nossas lideranças globais de Transfer Pricing e de International Tax, que nos privilegiaram com suas presenças aqui conosco, para além de todos os trabalhos que temos feito essa semana e vários workshops para entender tudo isso no contexto da realidade dos países latino-americanos, do Brasil, e para proporcionar aos nossos clientes as melhores soluções possíveis em relação a esses temas. Então, a gente vai partir desse panorama e aí a gente aterriza no Brasil com todos esses conceitos e passa a trabalhar como tudo isso tende a impactar a realidade tributária brasileira, a agenda de todos nós, profissionais da área tributária. Trazendo, além desta análise, uma pegada, acho que eu posso falar isso, extremamente concreta, extremamente pragmática, de como tudo isso afeta a vida do gestor tributário. E aí a gente vai ter o prazer de ter conosco aqui 3 executivas extremamente relevantes de multinacionais, gestoras tributárias com responsabilidades Latam ou globais, e um executivo também de uma multinacional, gestor tributário com responsabilidade Latam, dividindo conosco como é que eles estão encarando esses desafios no dia a dia deles, o que é que eles têm feito, o que é que eles têm experimentado. E aí, na sequência, ao longo da tarde, todos nós iremos para aquelas sessões paralelas em que teremos a oportunidade de explorar temas que são variações de todos os temas que a gente está trazendo para as sessões plenárias. Na sequência, na volta das breakout sections, para as quais todos vocês se inscreveram, mas vocês vão receber orientações adicionais de onde se dirigir para atender essas breakout sections a partir de cada um dos assuntos que vocês definiram. Na sequência, a gente encerra o nosso dia com um painel de perguntas e respostas, um amplo painel de perguntas e respostas, em que nós vamos estar considerando as perguntas que vocês enviaram para que a gente possa colocar para o painel. E aí um aviso, todos vocês receberam ontem e hoje uma mensagem com um link para apresentarem as suas perguntas. E essas perguntas vão estar, obviamente, passando por uma curadoria ao longo do dia, para que a gente possa selecionar e colocar para todos os panelistas que passaram por aqui hoje, respondendo as suas indagações, os temas que vocês entendem que devem ser endereçados. Caso algum tema não seja especificamente endereçado nesse painel, nos deixem saber, porque a gente tem a possibilidade de voltar para cada um de vocês e explorar esse tema. No contexto de todo esse dia, que eu espero que seja uma experiência muito positiva para todos nós, nós teremos um coffee break no meio da manhã, e nós vamos dar essas mensagens de forma muito clara no momento do coffee break, um almoço, em que nós vamos nos reunir no espaço externo aqui da nossa plenária. À tarde, um outro coffee break, que é o que antecede a volta de todos vocês para aquele painel de perguntas e respostas do Q&A. Encerrando essa minha fala de abertura desse evento que, de novo, eu espero que seja uma grande experiência entre todos nós, uma grande oportunidade para que possamos nos relacionar e possamos nos ajudar, nos apoiar em vencer esses desafios. Eu queria dizer o seguinte: para muito além de desafios, eu acho que a gente está num momento extremamente empolgante, num momento único das nossas carreiras de gestores tributários com setores tributários. Esse é o nosso momento, pessoal. Em 36 anos de carreira, eu comecei aos 12 anos de idade, em 36 anos de carreira, eu nunca vi um momento tão icônico. Em 36 anos de carreira, eu nunca vi uma reforma tributária sobre o consumo sendo aprovada, né, com tanto debate, com tanta participação da sociedade e tanta influência do contexto global em relação ao nosso ambiente tributário doméstico. Portanto, aproveitem esse momento, sem dúvida nenhuma, é de vocês, esse momento é nosso. E having said that, I would like to welcome to the stage two great friends and two great partners. Horacio Peña. Horacio leads our transfer pricing practices globally, and Doug McHoney, he leads our international tax services practices globally. I also would like to invite to the stage my partner, Romero Tavares, and my partner, Michela Chin. It's up to you guys now. Thank you.
Good morning, everybody. Thank you very much, Durval, for that excellent introduction. I would like to introduce myself as well as Horacio Peña, white, middle-aged Hispanic man. I'm based in New York City. I'm a tax principal in tax consulting. I've been in the firm for 31 years. And have been a witness of this evolution of the transfer pricing. So we're delighted to be here with you in São Paulo. It's great to be in São Paulo, and I think Durval did an excellent job at setting the tax agenda in the context of this historical inflection point, and I would call radical transformation, as Durval said, for what's coming for the rest of the day. So Durval asked me to start at a really macro level on the big trends globally. Transfer pricing, the arm's length standard, is also about economic conditions and business strategy. So it is very relevant to understand what's happening from an economic point of view, business strategy. What are those mega trends? Before we spend the rest of the day getting really specific on the international tax reform with Doug and Pillar 2, and then in the afternoon with the sessions and the breakout sessions, and get really specific in terms of all the things we need to do. So the CEO agenda, right? CEOs are fresh from Davos, and never before has AI governed the agenda so much. 58% of the CEOs think that they'll be using AI in transforming in their services in the next 12 months. 70% of the CEOs think that AI will play a significant role in the way they create value, the way they produce products and services and deliver those services to their clients. At the same time, the transformation agenda is live and well, and is at the same time is a huge opportunity and a huge threat. So according to our global CEO survey, 40% of CEOs believe that their operating models could be at risk and that their organizations are not fit. It may not exist 10 years if they don't deal with these challenges. And why? And the reality is that change has accelerated across the board, passing from COVID and the pandemic. Demand for products and services have changed. Consumers and industrial clients are changing their preferences in radical ways. There's new distribution ways. There's digital assets. There's new operating models. We are dealing with supply chain disruptions Tremendous amount of change. And of course, there's the fourth industrial revolution, AI, which is also creating new competitions, new threats, and new disruptions. So all of this is also creating, in addition to that, geopolitical threats, huge demand for energy. AI will require that we need double, 3x the type of energy that we'll need going forward. And at the same time, we need to save the planet in the process in the next 10 years for sustainability. So quite a challenge. It's not business as usual. We all lived through globalization for the past few years. One could say that we're now de-globalizing and that there's regionalization and localization. We're in the middle of a big China-US trade war and tech war. And so is definitely the rules have changed. We're now in the age of industrial policy. The US has implemented a very aggressive industrial policy. Europe is going through the Green Revolution. As part of the industrial policy with the Inflation Reduction Act and the CHIP Act, the game has really changed. There's hundreds of billions of dollars of investments going to the United States. The United States is going through a manufacturing boom that I have not seen in many, many years. Again, increase for energy has increased dramatically because of AI and data. The trade war is having immediate impact. China went from #1 trading partner to the United States to #3 overnight. Mexico became the #1 trading partner of the US, Canada #2, China #3. Foreign direct investments. The US has by far become the #1 foreign direct investment destination. Huge investments flowing to the United States. And things are shifting. Many of our clients are diversifying their supply chains around China, going to Vietnam, Indonesia, Brazil, Mexico, and others. Brazil is receiving a lot of foreign direct investment. It's probably going to overtake Hong Kong very soon in terms of foreign direct investment. So things have changed dramatically. Stock market in China has been down for more than 10 years. A lot of the Chinese champions' market share, market value have dropped by 70%. So the situation is changing very quickly. In the US macroeconomic environment, the central bank is winning the inflation war. Inflation is coming down. Interest rates are going down a little bit. But just as an example, the US ends up with $34 trillion of debt. $34 trillion of debt, historical proportions. 50% of that debt needs to be refinanced. And the interest on the debt is probably going to surpass the entire military spending in the United States. The US is not the exception. China has even more debt across the board as a percentage of their GDP. So all of this is translated into a massive need for tax enforcement and tax collection everywhere in the world, and tax increases as well. Shifting gears very quickly, we're not going to talk a lot about Pillar 1, but we want to set the stage for what Romero will talk about later and how this could impact Brazil, is there's been recent development just in the last 9 days. The OECD published a paper around Pillar 1 and the Amount B developments, which is supposed to intended to help taxpayers simplify some of the routine activities around marketing and sales areas. Again, something that could impact Brazil later on, and we're going to talk about that. Last year, we talked a little bit about the evolution of the transfer pricing regime. And so we have a well-established regime operating with laws, with regulations, with requirements, a lot of procedures, rulings, advanced pricing agreements. Now we're going into a new international tax regime. So it's not that we're abandoning the arm's length standard, it's that now we're going to create both systems, they're going to coexist. And that presents a tremendous amount of challenge. So what does success mean from a transfer pricing function perspective? And I think for Brazilian companies considering in earnest the transfer pricing policies, it's important to keep in mind the life cycle, I call the life cycle of transfer pricing. It starts with understanding, and transfer pricing is uniquely based on facts. It's the most intensely factually intensive area of tax. And so that's what's different, that's what's new in Brazil, that we have to consider the business strategies, the contractual terms, the economic conditions, the intellectual property, the new digital assets that we're creating and developing. Where are we creating and developing these assets? Where are we going to get these deductions? So we have to start with AI and what's happening from a technology and data perspective in our companies. Then we need to understand the business strategy, long-range plan of our companies, interact with finance, interact with the business, interact with what are the new investments, where are those investments going to take place, understand the tax function, and we'll have to transform the tax function because the reality is the tools that we have today, we don't have enough manpower, we don't have enough information. We're going to have to use revolutionary technology to deal with these challenges, and then we have to take into account sustainability. It starts with understanding the transfer pricing policy for each and one of our products and services. Then we go into implementation, execution, how we're going to actually set the prices on a month-to-month basis, on a quarterly basis, to make sure that we achieve minimum variances if possible. If we do the operational transfer pricing correctly, then the transfer pricing documentation should be much easier, because we will have tested parties' financials, we'll have results that we can use to document things. And then we want to avoid disputes, because we'll talk about disputes. Disputes are a big fact of life, and there's going to be tremendous amount of pressure to collect taxes. So dispute prevention is going to be a premium. And again, at PwC, we've developed a number of techniques to avoid and minimize those disputes. At the same time, success means we are very privileged to have worked with many private equity groups in the world, and we are very focused on value creation. And that value creation starts with creating sustainable, long-term sustainable operating models. It's not about just short-term thing, changing my policy 6 months from now, next year. We realize that these will require very big efforts, very real big investments, and we need to have a long shelf life. We need to solve this problem for the next 5, 10 years, not just for next year. And so part of it is, again, understanding, creating operating models, understanding what's happening in the business from a product services perspective, what are the supply chain changes, what are the investments, and try to create a sustainable digital advantage, tax advantage operating model. That's going to be success. If we don't do that, we'll end up with double, maybe triple taxation. There could be a lot of speed bumps along the way. So it's going to be critical that we achieve that. We're not going to talk about disputes right now. Just suffice to say, it is what it is that the biggest tax cases in the world have been transfer pricing cases. The cases in the hundreds of millions of dollars, the cases in the billions of dollars, whether it's Asia Pacific, whether it's Europe, whether it's the Americas. The biggest tax controversy cases have always been transfer pricing. And so now we're going to see with Pillar 2 and international tax reform, there's going to be a series of more complex issues. So getting it right has never been more important. At PwC, we try not to keep anything to chance. We focus on being really deliberate about creating those sustainable outcomes. So we have proven methodologies that we have developed and over time, over years, and tested with the tax authorities. And so for all of these things, we have, for example, the PwC STEP approach. First, understanding what are the drivers. Every company is different, right? Whether you're in industrial products, consumers, pharmaceuticals, life sciences, and every company is different and is changing very quickly. So we need to understand what are the core competencies. What are the things that really differentiate each company and create that value? What are the sources of value in step one? In step two, under the arm's length standard, we need to understand where is that strategic management? What are those activities that run that strategic management, that control the risks of the organization? And if we have intangible property that creates economic rents over time, then where are the DEMPI functions, the development, enhancement, maintenance, protection, exploitation of IP? Where are those functions? And where are those costs? Where are those intangible development costs? Do we want to have those intangible costs scattered across 100 countries and have every tax authority in the world challenge us on the creation of these digital assets and intangibles? Or do we want to centralize some of those intangible assets in locations where we have beneficial tax attributes that we can benefit from the planning? Finally, at the end, that's when we apply the transfer pricing method. First, we need to understand, again, core competencies, the drivers of that competencies, the IP, and then at the end, the transfer pricing method, a profit-based method or a transaction-based method to document our transactions. For Brazil, this means we're going through this change where we have to obviously evolve and change from the old transfer pricing methods, for the selection of the new methods. Are we going to use a surgical approach? We just have to tweak and modify a few little things? Or do we need to really transform and change the transfer pricing policies in a big way? That's the question for today that we'll be solving for. But make no mistake, this will not be successful if we don't tackle data. We have to own the data. And one of the things that we learned in the last 30 years in transfer pricing is that taxpayers that control the data and their facts will do well in this environment. If you don't control the facts, you don't control the data, tax authorities will interpret your facts in 15 different permutations, usually in a bad way for us. So understanding the data, what's the structured data that we need, what's the unstructured data we need, what are the calculations that we need to make. Remember in grad school, we have to solve for multiple variable equations, really complex. and actually probably nothing as complex as I've seen in Pillar 2. And so now there's no spreadsheet that can solve that for us, right? We need a completely different generation of tools that we'll talk about in order to actually run those computations simultaneously so we can actually solve this. AI, operational transfer pricing, will help, but it's not going to solve everything, right? We need the rule engines that are going to help us solve that. And Gen AI is going to be an enabler of that value that we're going to create. On top of everything else, we have a massive historical change in international tax regime with Pillar 2, with some digital service taxes out there, with tax analysis that needs to be put in place. And again, as an example, in the United States, the Congress gave $60 billion to the IRS. We have a new Biden IRS that has been hiring thousands of agents and attorneys and economists to undertake next generation type of transfer pricing audits, and the US is not the exception. We're going through exactly the same thing in Mexico and many countries in Latin America and Europe. There's new administrative guidance, there's new digitization tax enforcement, and that brings us to Pillar 2 and how these things are going to change at the same time.
All right. Thank you, Horacio. Good morning, everybody. My name is Doug McHoney. I am PwC's International Tax Services Global Leader. I'm also the host of the Cross-Border Tax Talks podcast. You can find that on YouTube or wherever you get your podcasts. Don't forget to like and subscribe. I look a lot like Durval, slightly younger, much wider, a bigger beard, and glasses. All right, so let's get into the material. Folks, Pillar 2 represents the biggest change that we've seen from a global tax system in my 25-year career. And I appreciate that I'm telling this to an audience that is going through, frankly, the largest country-specific international tax change that I've seen in my career. So I empathize with the clients, with the taxpayers here, with all the change that is coming. One of the concerns that I have is, with all of the change, are tax professionals really able to keep up with everything and really understand the implications of Pillar 2? So what is Pillar 2? Pillar 2 is the first global tax system of its type. Historically, every country had its own corporate international tax system, and now we have a tax system that will be theoretically consistent across jurisdictions. It applies to any company that has greater than 750 million euro revenue, and it's designed to ensure that every taxpayer pays at least 15% tax regardless of where they do business. It's very important to understand that it does not matter whether the parent company of your structure has implemented Pillar 2. I tell this to US taxpayers, I'm telling this to Brazilian taxpayers, because the US and Brazil at this point have not adopted Pillar 2. But if you have greater than 750 million euro top line revenue in your global organization and you operate in any country that implements the Pillar 2 rules, you are subject to Pillar 2. The other really big challenge for Pillar 2 is that it is based on the financial accounting standard of the ultimate parent entity. It effectively requires an entirely new set of books for you to be able to start these calculations. And the Brazilian accounting standard that you use, you will apply to all of the jurisdictions where you do business to be able to do this calculation. What are the key concepts? Because I think it's important to understand kind of what are the big picture concepts for Pillar 2 and how these rules apply. The first one is an income inclusion rule. And what the income inclusion rule does is it allows a parent company or an intermediate holding company to collect the top-up tax from its subsidiary. So you have to do the Pillar 2 calculations to determine if, from a Pillar 2 perspective, any subsidiary is below 15% tax, and if it is held by a parent company that implements the rules or held by an intermediary holding company that holds a lower tax subsidiary, there is a top-up tax. I think the most common example in Brazil would be a Brazilian parent company that owns a Spanish holding company. Spain is implementing the Pillar 2 rules for 2024, this income inclusion rule. So every subsidiary that you have below Spain, you will need to do the calculations to figure out whether you potentially have a top-up tax and the coordinating compliance. Generally, the income inclusion rule will be applicable in 2024. The under-tax profit rule, which is a extraterritorial taxation system, allows a subsidiary to collect a top-up tax starting in 2025 from a brother-sister company or from a parent company. I'm going to say that again. Starting in 2025, the under-tax profit rule allows a subsidiary to collect the top-up tax with no ownership chain, a brother-sister company or a parent company. There are a number of questions with respect to, is this in violation of tax treaties? Is this in violation of investment treaties? And I think we can anticipate a lot of litigation, both from countries as well as taxpayers in this regard. The third piece that I'll mention is the qualified domestic minimum top-up tax. This is a tax that allows an implementing jurisdiction to collect the Pillar 2 top-up tax from itself. So this is actually applied first in the calculation. A good example of this is Ireland. It has a 12.5% rate. Ireland is implementing a qualified domestic minimum top-up tax for companies that have greater than 750 million euro. So Ireland, instead of allowing some other jurisdiction to collect that 2.5% or whatever the Pillar 2 amount is, Ireland will be able to collect the top-up tax from itself. So one of the biggest challenges, and there are many challenges, is that the OECD, who has drafted these rules, is not a legislative body. So it requires every jurisdiction, and there are 36 that are implementing, or 37 now in 2024, and I'll show a map here in a few minutes, but every country has to implement the rules themselves. They have to go through their legislative process and regulatory process to get these rules in. Since the initial model rules and commentary have come out, we have seen 3 versions of administrative guidance, so additional guidance by the OECD, and you can see that in this timeline. As countries implement these rules, depending on what their legislative process is, and we also know that the OECD is going to continue to bring out additional administrative guidance, as they bring out additional administrative guidance, each country is going to have to bring in those rules themselves. Some countries have said that they are just going to, through an ambulatory approach, just automatically incorporate those rules, effectively turning the OECD into an administrative body. A number of countries cannot do that constitutionally and will need to go through their legislative or regulatory process. But what it means is that we could, even though there's a common framework for these rules, that we could have countries with varying degrees of these rules depending on what they choose to adopt. There's also flexibility in the particular rules that effectively, particularly for the qualified domestic minimum top-up tax, for example, that allows countries to use local statutory accounting as the base for the QDMTT instead of the financial accounting standard of the ultimate parent entity. For purposes of the income inclusion rule, for purposes of the under-tax profit rule, you have to use the financial accounting standard of the ultimate parent entity. Again, the income inclusion rule applies in 2024 for tax years beginning on or after January 1st. Generally speaking, the under-tax profit rule for 2025 applies in 2025. So again, the message is, it's here. There is a transitional safe harbor rule that also applies for 2024 and 2025 that can create some simplification, although I'll get into that. There are really big complications with respect to country-by-country reporting because that's the basis for the transitional safe harbor. One other point that I want to mention is that do not be fooled by the statutory rate of taxation in a jurisdiction for purposes of determining whether a country or whether one of your subsidiaries can meet the safe harbor or potentially has a top-up tax. Certain subsidies that are granted by jurisdictions, the US is a great example, like the R&D credit. Our research and development credit is a non-refundable credit. That subsidy is generally considered a bad subsidy for Pillar 2 purposes. And what do I mean by that? To the extent that US companies take an R&D credit, that effectively reduces the globe rate. And so the US has a statutory rate of 21%. At 4% for state taxes. I think most of us would think that, well, it's a 25% rate, that's not below 15, there shouldn't be any top-up tax. But that may not be the case, and that is just one particular example. And I had the privilege of interviewing Romero yesterday on our Cross-Border Tax Talks podcast. Stay tuned for that. And he was educating me that there are similar subsidies here in Brazil that could potentially cause Brazil to fall below 15%, despite all the various taxes and the high statutory rate. So don't be fooled by the statutory rate. Where are we in the world? You can see this map here. We have 36 countries that originally said they were going to enact. South Africa came in this last week and said that they are going to be enacted well. So we have 36 to 37 countries. 140 have signed on to this from the OECD, including the US. The US will likely not be enacting Pillar 2. We will see in 2025, 2026, after our presidential election, there are some significant changes that are happening to the US tax code. I anticipate that there could be major US international tax reform in that 2026 area. We'll see what happens with whether the US will adopt Pillar 2. We'll also see from a Brazilian perspective, we'll talk about the corporate tax reforms, whether Brazil will choose to adopt something and change the full inclusion system that you currently have for foreign subsidiaries. But Pillar 2 is here, and it is around the world. And so if you operate in any of these jurisdictions, you need to focus on Pillar 2. The transitional C/C safe harbors, this was intended to be something to make taxpayers' lives easier. And there are 3 different tests I'm generally not going to go through. But what the rules do is that they allow you, instead of doing the full, what we refer to as the globe income calculation, which requires a number of adjustments and a whole lot of data to be able to do these calcs, it allows you to use your country-by-country reports as the denominator in the calculation. And the thought was from the OECD, oh, this will be a lot easier for taxpayers. They could use their country-by-country reports and then apply one of these 3 tests. Well, in December, we got some recent administrative guidance, and one of the conditions to meet these C/C safe harbor, to meet the transitional country-by-country safe harbor, is that you have to have a qualifying country-by-country report. And we really didn't know what a qualifying country-by-country report. It generally said that you needed to apply either the financial accounting standard of the ultimate parent entity, or you needed to apply local statutory accounting. But that was really the only information that we got. So in December, the OECD told us that effectively the country-by-country report has to precisely reflect what was on the financial accounting statements for the year of the country-by-country report. So if you do a country-by-country report, and you make post-period transfer pricing adjustments. And in fact, I have traveled all over the world talking to taxpayers, and every single taxpayer that I have talked to pushes through post-period transfer pricing adjustments through their country-by-country report. I think all of us that have done work in this area would say, well, of course you do. You want the country-by-country report to reflect what was actually going to be paid in that particular jurisdiction. What the OECD has told us that if you make post-period transfer pricing adjustments and are not reflected in the books for the prior year and put that on your country-by-country report, your country-by-country report is not qualifying. Similar with purchase price accounting. If you do topside adjustments for purchase price accounting and you don't push those down for your book purposes, but you do push those down for country-by-country report, you have a disqualifying country-by-country report. And so I would caution taxpayers that as you are thinking about meeting these safe harbors, you really need to think about your country-by-country reporting process, and you also need to think about when you start that process. And the issue and concern is that the country-by-country report may not really adequately reflect the amount of tax that you're going to be reporting in each of these jurisdictions, because obviously you still have to do those transfer pricing adjustments, but they cannot show up in your country-by-country report. So another of the many challenges is operational readiness. For those that have not really started the process or just very early on, I will tell you, I've been leading the PwC's approach to this from a global perspective for almost 2 years. And it is amazing the amount of experts that we need to do this. I think originally when I was tasked with this, it was like, oh, this is an international tax. Let the international tax leader lead this from a global perspective. But what I've learned is that we need to have accounting experts involved, and not just tax accounting experts, accounting experts to understand how we interpret these rules. We need to have systems people involved, because we have done something called our data input catalog. You'll hear a little bit about that more later. There's about 270 data points that are required per constituent entity, so branch, legal entity, pass through. We think about 50% of that information is located within an ERP system, which means 50% is located outside of an ERP system. And so it is a massive data challenge that requires a broad group of stakeholders to help. And we need to think about people, process, technology, and data. And you'll hear all more about that as we progress today. So with that, I'm going to turn it back over to Horacio. I always feel like when I leave one of these discussions, I've just sucked all the wind out of the room, and I apologize, but I had nothing to do with these rules. I'm just explaining to you as they are. So thank you very much, and I look forward to any individual discussions or questions later.
Wow, Doug, that was a very clear presentation for an incredibly complex issue. But just a couple of observations on the transfer pricing, right? So the arm's length principle is still at the heart of the correct functioning of Pillar 2. It is basically implicit. In some countries have certain requirements around groups of transactions or principal transactions, making sure that they adhere to the arm's length standard. Under the Pillar 2 regime, they say all of the transactions have to be covered to make sure there's no subsidy, to make sure there's no disruption. And this impacts the calculation of the globe profit loss. It impacts the ETR, effective tax rate, and also as a consequence, any top-up tax. As Doug very well described, the whole rule procedure will radically change. There's going to be a huge premium for companies to get the transfer pricing done correctly, contemporaneously, truly contemporaneously. So for the last 30 years, tax authorities, the OECD has been talking about the importance of contemporaneous transfer pricing. But as Doug mentioned, in reality, literally 100%, 99.99% of companies execute post-period transfer pricing adjustments after the fact. And so there's going to be now a radical need to focus on operational transfer pricing to really, truly minimize those things, those adjustments, and make sure that before you finish the year, you actually capture 99% of your correct transfer pricing. And remember, that means aggregation of transactions, testing your results, applying your method, having certainty that you actually are meeting your targets, and you have the accounting, the alignment of tax, contracts, transfer pricing policies. As Doug mentioned, unfortunately, we haven't seen a single client that has, under the new rules, a qualified country-by-country safe harbor. Remember, country-by-country reporting was more of an information requirement before. Now, this is a very, very different situation in terms of how the safe harbor will apply. And if by definition you're using a post-period transfer pricing adjustment, that you do not have a qualified country-by-country safe harbor approach. Just a couple of other observations. From a compliance transfer pricing documentation perspective, again, it's going to be really important that we have all of the appropriate results. Unfortunately, in some cases, it will be impossible to achieve, and so therefore, we're seeing an increased demand of advanced pricing agreements and rulings all around the world. There's a waiting list in many countries. The APA program in the US, we're very busy. We have a 30% growth across all these areas. So there's going to be more pressure on that. Again, it's going to be more important than ever to get it right in the period, try to avoid controversy, and if necessary, also the complex and costly advanced pricing agreements, but they're going to be part of life. Operational transfer pricing, like never before, is going to be really important, and we're developing a lot of tools, working with Oracle, working with SAP, S/4HANA 4. We have a number of digital assets to accelerate the implementation of transfer prices and avoid post-period transfer pricing adjustments is really important. And then at the same time, we have to consider planning opportunities. So part of it is analyzing all that, having that data on a quarter-to-quarter basis to really see what can we do to mitigate the fluctuations of the globe effective tax rate, Where are we tracking? Is this going to end up with an unintended consequence, a very significant tax impact in any given jurisdiction? And some companies have legacy principal structures, right, different locations. And are those still viable, or we need to modify them in terms of cost structures, development intangibles, profit systems, and everything is changing with system profitability for the transformation agenda that I was mentioning before. The supply chain is happening around the world. All these things are impacting system profit. And ultimately, we need to analyze the system profit to be able to optimize our transparency policies and ensure that we avoid double taxation and we have appropriate results and sustainable results going forward. So to wrap up, I think the key takeaways as we discuss here, Doug and I, is data, data, data is going to be absolutely critical, and it's definitely radically different from what we've seen before in our careers, as Durval mentioned, and it's going to require a complete different set of process, technology, and experts, people. The calculations of Pillar 2 are incredibly complex, and we definitely, this is not a time to reinvent the wheel. Unfortunately, we don't have the time to reinvent the wheel. We have to leverage the cutting-edge technology that we have, the best solutions that we have, to actually apply them right away, because actually we're already almost in March of 2024, so there's not much time left. And it's all going to be about effective implementation, that we need to work with our stakeholders, with our board, with our management teams, understand the business strategy, what's going on with the digital AI transformation in our companies, what's happening from a data perspective, ERPs. We need them all. There are no silver bullets in terms of AI is not going to come in and save the day. We're going to have to combine all of our tools and processes to resolve this. And then finally, we'll need very effective documentation that tell a story really well to avoid controversy in the future. And the rest of the program, we have a lot of great workshops with demos, technology demos, case studies, and we'll dig into the details. Romero.
Yeah. Horacio, Doug, thank you very much. I'm Michela Chin. I'm a partner with PwC, leading the transfer pricing practice. I'm a Chinese descendant woman with dark brown shoulder-length hair. I'm wearing a navy blue blouse with a navy blue jacket and black pants. And also I have a pair of glasses on my head, which I need to use when things don't get net clearer at an arm's length, literally, yeah? So, but very nice, good morning to be here. Horacio, Doug, thank you so much for these valuable insights on the developments and global developments and trends. And when I want to echo what you have just mentioned at the end and what you and Doug said, the importance of how, for example, post-transfer pricing adjustments, right, can have an impact vis-a-vis the need for a qualified CBCR, and also in light of the Brazilian transfer pricing, local domestic legislation. So these topics and many others will be addressed when we bring down to the reality of the still in progress transfer pricing legislation that is now mandatory as from this year, and then we will address during the course of this day. Romero?
Thanks, Michela. And thanks, guys, for the excellent presentations. Great way to kick off what we're going to dig into once we get into the Brazil specifics. My name is Romero Tavares, for those who don't know me. I'm 10 years older from that picture you see on, on the screen there. But I'm a fairly large brown man dressed in black and blue, also with glasses to see things even when they're not at arm's length. But just to wrap things up and relate on some of the key points that these guys have made, Brazil is at a unique crossroad right now because we're doing tax reform, because we're doing corporate tax-wide tax reform, and because we just did the major transfer pricing reform, which is being regulated. So we have yet another opportunity for Brazil to jump on the right bandwagon, not the wrong bandwagon, and try to land these rules into our system in a way that is positive for the country, protective of Treasury, but that makes the Brazilian economy competitive and attractive in this time of friendly shoring. I don't know if we're friends anymore, but near shoring at least, and so forth. So some of the key points: Brazil remains, most of the inbound multinationals that operate here, they remain very capital intensive. This is a market destination country. This is an extractive economy. There are specific rules around that in the two pillars. This is a place where capital intensity payroll intensity is relevant. And we're going to discuss later on when we talk about Pillar 2 that the inspiration for these rules coming back from the US GILTI rules is to tackle residual income and not to tackle routine returns. So if we do the transfer pricing policies correctly, if we do the transfer pricing strategy correctly, if we can fit the facts and the narrative to the object and purpose of this new rule, there's a good chance that Brazil could fit into the carve-outs, into some of the potential avenues for not having a top-up tax here, even if we have subsidies, subvenções, etc. But that's a worthy exercise for the inbounds. And for the large Brazilian multinationals, the outbounds, the world is not your oyster anymore. It's an open clam. We basically were looking at really a system where things have to be run from here, because Brazilian accounting standards will apply everywhere, and yet we have a unique opportunity to replace our old and antiquated full inclusion rule, very punitive to Brazilian business, with a new system, a new robust CF system with the add-on of the Pillar 2 rules. We're going to dig into all of that very soon, and I just wanted to land things in Brazil as we wrap up the panel. So thanks, guys, for being here with us today, and thanks to the audience as well. And now I would like to get Marcelo Vieira up on stage with us for the next panel.